What if the calm you're feeling in the markets right now is not calm at all, but the quiet before something much bigger breaks? Because on a single day in August, Beijing quietly rewrote the rules of a fight that Wall Street thought was cooling down. Before we go further, if you want to actually understand what's coming, instead of just reacting to headlines when it's too late, hit that subscribe button right now. Not because I'm asking nicely, but because this channel is built for people who want to see the next move before it happens. Like this video, if you're still here in 10 seconds, and send it to one person who still thinks this trade war is over. It isn't. Let's start with what actually happened, because the details here matter more than the headline. On August 5th, China's Ministry of Commerce made an announcement that analysts are now calling the widest set of trade countermeasures Beijing has issued since a fragile truce was reached with Washington back in October. This wasn't a small warning shot. It was a coordinated package, hitting American companies, American technology, and American trade practices all at once. 7 American entities were named. 6 of them were added to China's so-called countermeasures list, a legal tool used under China's anti-foreign sanctions law. Beijing claimed each of these companies had helped enforce U.S. sanctions related to China's Xinjiang region. The 7th company, based in Arizona, was hit separately, tied to a decision by the U.S. Federal Communications Commission targeting Chinese-made robotics and drone technology. But the entity list was just the opening move. Right alongside it, Beijing tightened licensing rules for drone exports heading to the United States. China already controlled these drone components under its dual-use export list, but now any shipment bound for America faces what Chinese officials called strict case-by-case review. The easy, streamlined approval process that used to exist is gone. This matters more than it sounds like it should, because China isn't just a big player in the drone industry. It's the dominant one. Companies most people have never heard of, sitting inside Chinese industrial parks, build a huge share of the world's commercial and industrial drones. When Beijing tightens that tap, it isn't targeting a small niche. It's touching an entire global supply chain. Then came the second move, and this is the one that quietly worries trade lawyers far more than the drone rule does. For the first time ever, China opened what it calls a national security investigation into imported goods, specifically targeting printing and copying equipment. On the surface, that sounds almost random. Office printers are not exactly a headline-grabbing industry, but the legal tool Beijing used to open this investigation had never been triggered before. And once a government builds a new legal pathway, it rarely uses it just once. Trade lawyers who track Chinese policy closely have pointed out a pattern here. Governments often test a brand new enforcement tool on something small and low risk first, before expanding it to categories that actually matter economically. Printers today, something far bigger tomorrow. That is the quiet warning hidden inside this story. So why did Beijing do all of this now, at this exact moment? Because none of it happened in a vacuum. China's own Commerce Ministry said clearly that these countermeasures were a direct response to a string of American actions taken over the previous weeks. The U.S. Federal Communications Commission had banned imports of Chinese-made drones. The U.S. Department of Homeland Security had added more than 40 Chinese companies to a blacklist connected to forced labor concerns in Xinjiang. On top of that, Washington had sanctioned Chinese shipping operators accused of handling Iranian oil, added Chinese universities to a Pentagon watch list, and reportedly threatened sanctions against Chinese artificial intelligence companies directly. Beijing's official statement did not hold back. It accused the United States of seriously damaging what it called the important understanding reached between the two nations' leaders. That single phrase is the key to why this story matters so much more than the usual back and forth between these two countries. Because back in May, something genuinely rare happened. The American president traveled to Beijing for a face-to-face meeting with China's leader, the first time a sitting U.S. president had visited China in nearly a decade. Markets didn't expect fireworks from that meeting. They just wanted signs that things were stabilizing. And by most measures, that's what they got. Both sides spoke about common ground. An invitation was extended for a return visit to Washington, expected to land in late September, timed around the United Nations General Assembly gathering in New York. That was the mood heading into summer. Cautious optimism. A sense that maybe, just maybe, the worst of the trade tension was behind us. And then August 5th happened. Analysts who track Beijing's every move for a living describe this moment differently than they describe the dozens of smaller disputes that came before it. One well-known China policy expert, speaking on a financial news program, said something worth remembering. Both governments, in his words, are trying out new sanctions and new restrictions, specifically so they'll have something to trade away later. In other words, escalate first, so you have leverage to give something up in front of cameras when the leaders finally sit down together. That single idea reframes everything. This may not be a sign the relationship is falling apart. It might be a calculated, almost theatrical buildup of pressure, designed purely to create bargaining chips ahead of a high-stakes summit. But here's the uncomfortable truth. Nobody, not the analysts, not the traders, not even the officials involved, can say for certain which version of the story is true. And that uncertainty itself is exactly what makes markets nervous. Because when powerful institutions can't tell if an escalation is theater or something more permanent, they hedge. And hedging on this scale moves prices. Let's rewind slightly and trace how we actually got here, because this didn't come out of nowhere. The conflict over drones and robotics didn't start in August. It started months earlier when American regulators banned the import of new drone models and drone components from foreign manufacturers, citing national security concerns. That earlier decision quietly set the stage for everything that followed. China, on its own side, had already been tightening its own export controls on drone-related technology for years, well before this specific dispute became front-page news. Both governments, in other words, have been independently hardening their positions on unmanned systems and robotics for a long time. What changed in August wasn't the existence of tension, it was the intensity and the coordination of the response. One Beijing-based analyst described China's new package of measures using a phrase that deserves your full attention. He called it evidence that China has spent the last several months building out its countermeasures toolkit. Think about what that phrase actually implies. Not a single angry reaction, not a one-time punishment. A toolkit. A permanent, reusable set of legal weapons, entity lists, licensing restrictions, national security investigations that Beijing can now pull off the shelf whenever it wants, without needing to invent a new justification each time. That's a structural shift. For years, the flow of trade restriction ran mostly in one direction, Washington limiting what advanced American technology could reach Chinese companies. Now, Beijing appears to be building its own mirror image of that system, aimed squarely back at the United States. If you're finding this useful, do me a quick favor. Tap that like button right now, not later, right now while you're thinking about it. It genuinely helps this video reach more people who need to understand what's actually happening here instead of just watching stock prices bounce around with no context. Now let's talk about the part of this story that touches your portfolio the most directly, even if you've never heard of it. The fight over artificial intelligence chips and a loophole that has apparently let some of the most powerful computer hardware on Earth quietly reach Chinese companies anyway. For years, the United States has restricted the direct export of advanced AI chips to China, worried that this hardware could accelerate Chinese military and technological capabilities. But according to detailed reporting, several major Chinese AI companies have reportedly been accessing this exact restricted hardware anyway. Not by importing the physical chips, by renting access to them remotely through data centers located outside China in countries like Thailand, Malaysia, and Japan. Here's how it apparently works, explained simply. U.S. export law controls the physical transfer and ownership of a chip. It does not control who gets to remotely log in and use that chip's processing power from thousands of miles away. So a Chinese company doesn't need to smuggle a chip into Beijing. It just needs to rent computing time on a chip sitting inside a data center in another country, log in over the internet, and run its most advanced AI models, exactly as if that hardware were sitting in its own building. This is not a theoretical loophole dreamed up by worried researchers. A seniors White House technology policy official publicly accused one major Chinese AI company of using this exact method, training an advanced model using top-tier chips accessed through a facility in Thailand. Separately, another major Chinese tech company was reported to be working with a Singapore-based cloud provider to access similar computing power based in Malaysia. That cloud provider has said its operations are fully compliant with regulations, and that its customers never physically own or touch the underlying hardware. One national security researcher described this loophole in blunt terms, calling it a direct threat, arguing that chip restrictions exist precisely to prevent China from using cutting-edge American technology to build frontier artificial intelligence, regardless of whether the chip physically crosses a border. Congress has already tried to close this exact gap. A bill designed to extend export control law to cover remote, cloud-based access, not just physical shipments, passed the House of Representatives by an overwhelming, genuinely bipartisan vote. One of its sponsors put it plainly, export controls are only as strong as their weakest link, and right now there's a real way around them. But that bill has stalled in the Senate, facing pushback from parts of the cloud computing industry worried about compliance costs and global competitiveness. And that stall matters enormously, because every single week this loophole stays open is another week. Chinese AI labs can keep narrowing the gap with American competitors using American hardware accessed indirectly. This is not a slow-moving background story. It is happening right now in real time while lawmakers debate. Layered underneath all of this sits an even older fight, one that's been quietly shaping global supply chains for over a year, rare earth minerals and critical materials, the raw ingredients used in everything from fighter jets to electric vehicles to the very servers powering advanced AI chips. China's rare earth export controls have followed a genuinely rocky path. Sweeping new restrictions were announced last October, then officially suspended weeks later as part of a broader de-escalation effort. But the underlying licensing system never fully disappeared. It kept expanding quietly, even during the pause, with new materials added to control lists throughout the year. Then, in June, tensions flared again when China added American entities to its own export control list, including companies directly involved in rare earth mining, a move that followed similar action from the American side targeting Chinese-linked entities in defense contracts. The financial impact of all this back and forth is not abstract. The benchmark price for a critical rare earth compound used heavily in permanent magnets jumped more than 20% in a single month earlier this year. That's the kind of price swing that ripples through manufacturing costs for months afterward, even before it shows up on a store shelf. And there's public pressure adding fuel to this fire too. Reports suggest the American president grew frustrated with how slowly Beijing was implementing the earlier rare earth agreement, reportedly threatening steep new tariffs if China failed to supply rare earth magnets at the pace Washington expected. That threat, sitting right alongside the drone restrictions, the chip loophole fight, and the entity sanctions, shows just how many separate battles are being fought simultaneously between these two economic superpowers, each one capable of shaking markets on its own, without needing a single dramatic breaking point. Before we go further into what this all means for investors, let's pause for one more thing. Comment below, right now, which part of this story surprised you the most? The drone restrictions, the chip loophole, or the rare earth swings? I actually read these, and it helps me know what to dig into next. Now let's zoom out, because the tariff backdrop is what ties all of these individual fights together into one bigger picture. Effective tariffs on Chinese goods have remained elevated, sitting around 22% according to recent analysis, well below the staggering peak of over 100% that was reached during the worst point of this conflict, but still roughly double where tariffs stood before this entire period of tension began. Analysts describe this with a genuinely two-sided view. On one hand, today's lower rate suggests real de-escalation compared to the peak, and neither government has much appetite to reignite that level of conflict right before a major diplomatic summit. On the other hand, even this reduced rate remains historically high, and further reductions look unlikely given that Washington continues pursuing separate trade investigations, targeting China and other trading partners at the same time. There's also a quieter, less visible layer to this story, one that speaks directly to investor psychology rather than any single policy. Foreign investors have grown increasingly cautious, not just about specific export controls, but about the unpredictability of China's own internal policy environment. A recently announced investigation into a former senior Chinese securities regulator, someone well known and respected among Wall Street investors who worked in China for years, has added to a sense of unease. The concern isn't really about that one official. It's about the pattern. A well-known, market-friendly figure can suddenly become the subject of an opaque investigation with little warning and little explanation. That kind of unpredictability makes long-term capital allocation decisions genuinely harder for institutional investors, regardless of what's happening with tariffs or drone licenses in any given week. There's also an institutional layer to this that's easy to miss amid all the sanctions headlines, but it says a lot about how prepared the private sector actually is for whatever comes next. A mechanism both governments had discussed setting up, meant to give the private business sector a formal channel into these high-level negotiations, has effectively stalled in the weeks leading up to the expected September summit. According to industry sources, neither side has genuinely initiated the consultation process yet. That matters because it suggests this entire relationship is currently being managed almost entirely through top-down sanctions and leader-to-leader diplomacy, rather than through the kind of steady, technical business engagement that tends to produce more stable, predictable outcomes over time. And then there's a geopolitical wrinkle sitting quietly underneath everything else, one that has nothing to do with tariffs or chips directly, but that several analysts say is shaping the temperature of this entire relationship. China remains an ally of Iran amid ongoing regional conflict, and reports suggest Beijing has plans to sell certain military equipment to Tehran, a development that reportedly left the American president openly disappointed. Separately, previously classified documents alleging Chinese interference in a past U.S. election were released this summer, though there are signs of hesitation about pushing that specific issue directly in upcoming talks. At one point, the American president made a remarkably candid comment to reporters, essentially admitting that both governments are engaged in an ongoing, roughly symmetrical campaign of pressure tactics against each other, even while both sides continue describing their overall relationship in far warmer public terms. So here's where all of this actually leaves us. China issued its broadest package of trade countermeasures since last year's truce, sanctioning American companies, tightening drone exports, and opening a brand new kind of national security investigation, all explicitly framed as retaliation for a specific string of American actions. Analysts widely believe this is a deliberate, strategic escalation designed to build negotiating leverage ahead of a major summit expected next month, with many expecting at least some of these measures to be quietly walked back once the two leaders actually meet in person. But that outcome is not guaranteed. Nobody can promise you that. Layered on top of that sits an active, ongoing loophole allowing major Chinese AI companies to remotely access America's most advanced computing chips, a gap Congress has voted to close in one chamber but has not yet closed in the other. And running underneath both of these stories is the older, still unresolved fight over rare earth minerals, where suspended controls, expanding restrictions, and sharp price swings continue creating genuine uncertainty for manufacturers who depend on materials that mostly come from one country. None of these fights exist in isolation. They're all happening at once, quietly overlapping, each one capable of moving markets independently, each one adding pressure to a relationship that both governments insist is stabilizing, even as the evidence on the ground tells a more complicated story. Here's the part that should actually stay with you after this video ends. Markets don't usually crash because of one single headline. They crash or shake violently when a dozen small, seemingly unrelated pressures build up quietly in the background, unnoticed by most people, until they finally connect all at once. The drone restrictions, the chip loophole, the rare earth swings, the stalled institutional channels. Each one looks small on its own. Together, they form something much bigger. And whether that something resolves peacefully at a September summit or turns into the next real shock to global markets is a question nobody can answer with certainty yet. But now you know exactly what to watch for. And that alone puts you ahead of almost everyone still scrolling past these headlines without understanding what's actually underneath them. If this video actually helped you see the bigger picture, don't just scroll away. Subscribe so you're here for the next update the moment something changes. Because with this relationship, something always changes. And if you know someone who's been asking why the market feels shaky lately, send them this video instead of trying to explain all of it yourself. Let's talk again very soon.